Welcome, everyone. When you think about building wealth, what comes to mind? Is it like winning the lottery?
Yeah, those big dramatic moments, right?
Exactly. Or maybe finding the next big thing, way before anyone else catches on.
We're having some kind of secret insider knowledge.
Right. These like almost movie like events that just change everything overnight. But what if the real way to get significant financial growth, lasting wealth, is actually simpler?
A lot simpler and maybe more accessible.
And yeah, profoundly consistent. That's the surprising part. So today, we're not just going to scratch the surface. We're doing an in-depth analysis, really looking at what our research shows about how wealth actually gets built up.
hmm
This isn't about like chasing the latest hot stock or trying to perfectly time the market. I mean, our findings suggest that usually just leads to frustration, doesn't it?
Yeah, mostly underperformance, actually.
So instead, we're framing this as an educational exploration. We want to look at the proven principles for long-term financial stability.
And focusing specifically on that power as consistency.
Yes. And the kind of elegance of simple investing in broad, diversified assets.
Our mission here, really, is just that.
hmm
To pull out the most important nuggets of knowledge from all the material we've gathered.
Yeah.
We want to offer you, a genuine shortcut to being properly well-informed about a strategy that, well, according to all our research, consistently let's call them ordinary people, become millionaires.
Ordinary people become millionaires. I like that.
Yeah. And we're going to highlight some maybe surprising facts and shine a light on insights that we genuinely think can fundamentally change how you understand investing.
Right. How wealth is really built
Yeah,
over decades, not days.
exactly.
So, what can you expect today? Well, we're going to take you on this journey, sort of distilling the core elements of this whole approach.
Mm.
We'll get into why just keeping buying month after month into, diversified assets might just be the most powerful thing you can do financially.
It sounds almost too simple, doesn't it?
It does. It's kind of a revelation in its simplicity, like the quiet power of just sticking with it. And yeah, we're excited to unpack it with you, offer some perspectives that maybe get lost in all the financial noise out there.
For sure.
Okay, so let's really unpack this. As we went through all our research, peeling back the layers, one word just kept jumping out. It was almost surprising how often it appeared as the absolute foundation of real sustainable wealth consistency.
Yeah. It's not flashy. You don't see it in the headlines much.
No, but our analysis showed it's the undeniable engine behind long-term financial growth. But what does that really mean when we talk about investing?
hmm
Which can be complex, sometimes volatile.
Right.
Our findings are actually pretty clear. Consistency isn't, putting money away just once or only when you feel good about the market.
Yeah, not just when things are going up.
Exactly. It means continuing to invest month after month, year after year without stopping, like through thick and thin, highs and lows.
That disciplined, ongoing nature.
Yes. It's that disciplined, relentless, almost boring commitment that the data showed really separates the long-term wealth builders from, people always chasing the next shiny object.
It's not a one-off thing.
No, it's not a one-time act, put a lump sum in and forget it. And it's not sporadic either, like investing only when you feel like it or when the market's doing great.
Right.
It's about setting up this continuous, regular commitment, a kind of financial rhythm, you could say.
I like that, a rhythm.
Yeah, and this disciplined approach makes sure that new money is always being added to your investments, which is crucial, right? Because that's the fuel for compounding and growth over
Bro,
time.
absolutely critical. Keeps your money working, keeps it in the market, accumulating.
Always there, always growing for the future.
And what's really compelling here is, like you said, this isn't just theory. It's not just an idea. It's the actual engine behind pretty much all the successful long-term wealth strategies we saw in the research.
The fundamental engine.
Yeah. It's about setting up that rhythm, that steady, unwavering flow of money into your investments. And that lets your existing money work incredibly hard for you.
Without you needing to constantly jump in.
Exactly. Without needing to intervene or second guess or speculate all the time. It's really the opposite of that common idea that you need to find the next hot stock or time the market perfectly.
Which our research showed just doesn't really work reliably.
No, it's very clear. It's not about making a lucky guess on some startup or chasing those, flashy short-term gains you see everywhere.
Yeah, those often end up being traps, right? They derail people.
They absolutely do. Lead to frustration and often actual losses. Instead, the kind of profound simplicity of this consistent way is what's striking.
Simple but powerful.
Right. Real, lasting wealth, as our analysis showed again and again, is mostly built through just disciplined, consistent investing. It's definitely not a sprint.
It's a marathon.
It's a marathon. And consistency is your pace setter. And this continuous application of these simple principles, it harnesses two incredibly powerful forces, which I know we'll get into.
Compounding and market recovery.
Exactly. Compounding returns and the market's ability to recover. You could think of it like a consistent workout routine. Like one session doesn't feel like much, right?
Right, you don't see results immediately.
But do it consistently over time, and the cumulative effect is transformative. Or maybe like building a house brick by brick.
Okay, yeah.
One brick doesn't look like much, but you lay them consistently, day after day, year after year.
And eventually you have a mansion.
You build something really significant and lasting. That's the idea.
And our research really drove this home. That discipline, that consistency, it's not just a habit. It's like the key that unlocks the most potent force in finance, which is compounding. This is where it gets really interesting, isn't it?
Absolutely.
Yeah.
This is the magic.
Our findings clearly show how this exponential growth is the real way ordinary people become millionaires. Not by lottery wins, not by chasing hype stocks.
Exactly. And for many people listening, compounding isn't a new word. Money growing on money.
Right, we've heard of it.
But what our research really hammered home wasn't just what it is, but the incredible speed at which it accelerates over long periods.
That acceleration is key.
It really is. It turns even small, consistent contributions into really significant wealth. It's that exponential growth that often gets underestimated that really changes the game for consistent investors.
Like a snowball rolling downhill.
That's a perfect analogy. It doesn't just get bigger, it picks up more snow, gathers mass, gathers momentum exponentially.
Right.
And the longer it rolls, the bigger and faster it grows. And the returns your money makes, they start making their own returns. And those returns make more returns.
It just keeps building on itself.
It's a continuous accelerating cycle. That's the engine.
And our analysis had some really great examples that make this super clear. Let's take a historically conservative average return, say 9% a year, which is roughly the S&P 500 average over the last century, right? Including dividends.
Yeah, a reasonable long-term average.
Okay, now consider this perspective from the material. If you consistently put aside the cost of a daily fancy coffee, maybe just $16 a day.
Which, for many, is less than an impulse buy online or something.
Totally. Just $16 a day invested consistently month after month. If you did that for 30 years, our calculations showed it could grow to nearly $1 million.
Wow.
Specifically, around $910,000. Think about that. A small, consistent habit, $16 a day over 3 decades. Almost $1 million.
That's the quiet power right there, turning micro contributions into macro wealth.
It really is.
And if we connect that to the bigger picture, you see that time isn't just a factor here. It's the ultimate multiplier.
The multiplier effect.
Yeah. The earlier you start, the more decades your money has for that compounding to really take off and reach its full potential. Our research looked at, various examples, even conceptual ones, showing people who started small in their early 20s.
Right.
By retirement, just through compounding and sheer consistency, they built really substantial wealth. It completely flips that overnight success story on its head.
Replaces it with the more reliable story of just sticking with it.
Exactly. Consistent effort.
Okay, what about another scenario? Our research also looked at what if you could invest more? Say $1,000 a month.
Okay, so stepping it up, that's around, 33 GLers a day?
Roughly, yeah. So $1,000 a month consistently for 40 years this time.
So adding an extra decade.
Right. As a result, it could be over $4 million. Around $4.36 million, to be precise, based on that 9% average. The difference between 30 years and 40 years, it's just astounding.
That really shows the exponential curve kicking in, doesn't it? When you give it enough time.
Absolutely. That patience literally pays off.
It's financially rewarded. Yeah.
And just to give people a broader picture, our research had this really clear table showing the power across different amounts. It's not just hypothetical.
Right, based on historical averages and that compounding force.
So if you invest $100 a month, the analysis showed you could potentially see around $182,000 in 30 years.
Okay.
Or $436,000 in 40 years.
Still significant from just $100 a month.
Definitely. Now, jump to $500 a month, that same $16 a day we talked about.
Yeah.
In 30 years, $910,000. In 40 years, a remarkable $2.18 million.
Wow. Over $2 million from $500 a month.
And if you consistently manage $1,000 a month.
Okay. the 33 fill a day scenario.
You're looking at $1.82 million in 30 years and an astonishing $4.36 million in 40 years.
That $4.36 million again, it's incredible.
These numbers just scream that even if you start later, maybe you can't do 40 years.
Right.
The research overwhelmingly shows that disciplined consistency still beats trying to time the market or chase trends. Hands down.
Absolutely. The market rewards patience, not quick gains.
It pays that patience dividend, as the material called it, which links right back to just giving your investments enough time. Don't interrupt them.
And that patience dividend is such a critical insight. What the research meant by that, I think, is the extra gain you get, not just from the market going up generally, but specifically from not making the common, costly emotional mistakes.
Like panic selling.
Exactly. Emotional trading, trying to time things perfectly, chasing fads that just disappear. By just staying the course, committing to that regular contribution, letting time work, you effectively collect this extra dividend.
How does that show up?
Well, it shows up as faster compounding because you're not interrupting it, and crucially, avoiding those behavioral mistakes, which, added up, our data showed, can be worth way more to your long-term wealth than any attempt to actively trade or outsmart the market.
Okay, so consistency is king, time is the multiplier. The next logical question our research tackled head-on is, what? What should you actually be consistently investing in to make this work best?
Yeah, the practical part.
And thankfully, the answer was surprisingly, almost refreshingly simple, especially when finance seems to love complexity.
Right.
Our research specifically and repeatedly recommended well-known, time-tested, exchange-traded funds, or ETFs, like VOO.
VOO comes up a lot.
It does. So for anyone not super familiar, VOO is an ETF that basically tracks the S&P 500 index. Meaning, by investing in VOO, you're essentially investing in a slice of the 500 biggest U.S. companies. You're participating in the overall growth of the U.S. stock market.
Which brings up a really important question, and something our research spent a lot of time on. Why not try to pick the next Apple or the next Tesla? Those stocks that go to the moon.
Right. The temptation is huge.
It is. But what's really compelling is that trying to consistently beat the market by picking individual stocks or making speculative trades, well, our research consistently showed it's a common and often really damaging mistake.
Those people fail at it.
The data is overwhelming. Most attempts fail. People end up with lower returns, more stress. This diversified ETF strategy, like with VOO, it just simplifies things dramatically.
How so?
It lets you ride the collective growth of the whole market without needing to bet on specific companies, which carries significant risk, right?
Yeah, one company can go bust.
Exactly. And it totally removes the burden of doing constant, deep research into individual companies.
Yeah.
Or trying to predict the next big winner.
Which is exhausting.
It's overwhelming, time-consuming, and honestly pretty risky for the average person.
Exactly. The beauty of VOO, or similar broad market ETFs, isn't just the diversification, though that's huge. Our research also highlighted the psychological relief it provides.
That's a great point.
You get the compounding power, the long-term stability that comes from literally owning the entire U.S. market.
You're not putting all your eggs in one basket.
No. You're spread across hundreds of the biggest, most established, generally sound companies. That diversification is like a safety net against any single company messing up badly.
And the track record speaks for itself.
It really does. The S&P 500, which VOO tracks, has averaged that 9–10% return annually for the last century. That's incredibly consistent long-term growth.
Yeah.
So what this means for you, the investor, is you absolutely don't need to do endless, exhausting research on single companies.
That burden is just lifted.
Right. It frees you from that analysis paralysis, the anxiety of trying to pick winners, because you're already tapped into the proven success of the whole market.
And that's precisely where a lot of people, as our research found, fall into that I can do better with my money trap.
The side hustle idea.
Right. There's this deep belief, often fueled by those rare success stories you hear about, that you can somehow beat the market with clever side hustles, or launching a business, or day trading, or options.
Risky stuff.
Very active, often speculative approaches.
Yeah.
And look, sure, a tiny few might hit it big that way, but our research shows the vast majority who try, they fail to even match, let alone beat, the consistent returns of just simple, diversified market investing.
Why is that?
Well, those approaches often lack the same compounding power, because money is going in and out, or it's concentrated. And crucially, they lack the stability and diversification you get from just owning the whole U.S. market through something like VOO.
So the S&P 500's long climb is more reliable?
Far more reliable for most people. Despite the short-term bumps, even the big crashes, its overall trajectory demonstrates that broad market participation is a less stressful and ultimately usually more profitable path than trying to outsmart it with concentrated bets.
Be a participant, not an expert mechanic.
Exactly. Be a quiet, patient participant in the big engine of economic growth.
Okay, now let's definitely talk about the elephant in the room. The big fear for so many investors, new ones, and even experienced ones, market crashes.
Yeah, can't ignore those.
It's a huge, totally legitimate fear, and our research tackles it because you have to understand it to stay consistent.
Absolutely critical.
Market crashes happen, they're a real cyclical part of investing, and they feel awful when you're in them watching your money seem to vanish.
Gut-wrenching, yeah.
Our research points to specific examples we all remember, like the dot-com crash, 2000 to 2002, market down nearly 50%,
Brutal.
or the Great Recession, 2008-2009. Stocks fell over 50%.
Even worse.
And, more recently, that COVID crash in 2020 plunged 34% in just weeks.
That was terrifyingly fast.
These aren't small dips, they're huge downturns that make anyone question everything. Every instinct screams, get out.
But, and this is the crucial insight, maybe the most reassuring thing backed by, like, a century of data in our research.
Okay.
The market always recovers.
Mm-hmm.
And historically, it always reaches new all-time highs after every single major downturn.
But always.
Always, historically speaking. This consistent pattern of resilience is the absolute bedrock of long-term investing. Understanding it is key to maintaining that discipline we keep talking about.
So looking back at those crashes,
Yeah, look at them. Dot-com bubble bursts. The market didn't just get back to where it was, it surged way past it in the following years.
right.
Great Recession. Devastating, yes. But the S&P 500 fully recovered by 2013. Just 4 years later, basically. And kept climbing.
Okay.
And the COVID crash. That recovery was incredibly fast. Back to record highs within months. This pattern, this resilience, is exactly why staying invested during downturns is so powerful.
Even though it feels wrong at the time.
It feels completely wrong. But it's counterintuitively beneficial. It lets you buy stocks on sale, basically.
Buying a discount.
Exactly. You acquire more shares for the same consistent monthly amount. Then, when the market inevitably recovers, which it always has,
Those discounted shares benefit even more.
hugely more, contributing significantly to your long-term gains. It's like shopping during a massive sale. You get more for your money, and when prices go back up, you profit more from those bargains.
Okay, that makes sense. But beyond market crashes, our research pointed to another big pitfall, something that trips people up consistently. We called it the instant gratification trap.
Ah, yes, the need for speed.
Exactly. This is the psychological barrier that stops people from sticking to that consistent long-term path. It's that powerful, almost primal urge for quick returns.
Rod
right?
Ridge, quick. Seeing
Excellent.
results now.
Yeah, and we see examples everywhere. Chasing those meme stocks that explode and then often crash just as fast, leaving people holding worthless bags,
Yeah.
or gambling on hyped companies with shaky fundamentals, just driven by social media buzz.
Right.
And like we just talked about, it's also that impulse to panic sell during downturns. The immediate fear just overrides the long-term logic and historical proof of recovery.
And what's really fascinating, and maybe frustrating for investors, is how deep this runs psychologically. Our research looked into behavioral economics,
Uh-huh.
and it shows our brains are often wired for immediate rewards, which just clashes head-on with the slow-burn, long-term nature of building wealth through consistent investing.
We want results now.
We crave immediate feedback. And the financial world, unfortunately, feeds that with headlines about overnight successes and meme stock millionaires.
But those are the exceptions, not the rule.
Absolutely the exceptions. The data consistently shows that while those stories grab headlines, the vast majority trying for those quick wins actually fall behind.
Yeah.
They end up with less than if they just stayed the consistent course.
So the market rewards patience, not impulse.
Fundamentally, yes. It rewards patience, that quiet discipline that lets the long-term economic engine do its work. Our research is clear. Most short-term trends or speculative trades tend to emerge dramatically, burn brightly, and then fade away.
Leaving disappointment behind.
Usually, yeah. While consistent investors in broad market ETFs consistently succeed, think about it, every decade brings new trends, right? Dot-com stocks in the 2000s,
Meme stocks in 2021.
crypto booms and busts, but most fade. The truly successful investors, our analysis showed time and again, aren't the ones guessing the next big thing or panicking on dips,
They're the ones just...
keeping buying month after month. It's about cultivating that discipline to resist chasing shiny objects and just focusing on the quiet, compounding power of the market itself.
Okay, so after all this analysis, what does it really mean for you listening right now and your financial future?
Yeah, the bottom line.
Our entire analysis, based on all the research we dug into, it really boils down to this elegant, powerful three-part formula for long-term wealth.
Simple, accessible, and it works.
Exactly. First, don't try to guess the next big thing. The data says that chase is almost always a losing game, financially and emotionally.
Check.
Second, just as vital, don't panic when the market dips. Remember what we found? Those dips aren't disasters. They're often the best opportunities for consistent investors to buy cheap.
Turn fear into opportunity.
Right. And third, maybe the most important piece, the core action. Just keep buying, month after month.
That simple, consistent action.
That consistent emotion-free action combined with smart investing like in VOO is the foundation of lasting wealth. This, our research stated unequivocally, is the real path to long-term wealth.
Summarized perfectly in the material. Consistency. VOO. Time.
Consistency. VOO. Time.
Love it. And if you connect that to the bigger picture, it's really about adopting a mindset. A mindset that prioritizes discipline and the proven power of the market over those fleeting trends or tempting shortcuts.
The simplicity is its strength.
It really is.
Yeah.
It removes all that complexity that often just paralyzes people, makes them feel like they need an MBA to invest.
Yeah.
Look, this path isn't flashy. It's not sexy. It definitely won't make you rich overnight or give you a dramatic story for parties.
Right.
But the overwhelming evidence from our research is clear. It works. It just flat out works. It's like a quiet testament to the huge power of persistent, consistent effort over a long time.
Let the engine work for you.
Exactly. Let the big, resilient economic engine do the heavy lifting steadily, reliably, without needing your constant worry or intervention.
Okay, and that brings us towards the end of our analysis today. We've really gone through the huge impact of just being consistent.
That often underestimated power.
Yeah, delved into the exponential magic of compounding over time.
Turning small amounts into large ones.
And highlighted the amazing simplicity and effectiveness of just using diversified ETFs like VOO.
Keeping it simple.
What we've learned straight from our research is that this isn't some complex strategy just for the super rich. It's a sustainable, accessible, and a really powerful path to wealth for pretty much anyone willing to embrace consistency and patience.
Anyone can do it, really.
So now, just a quick thought for you, our listener, to maybe reflect on. If consistency and patience are so clearly powerful for building financial wealth, what other areas of your life, maybe personal growth, learning a skill, even improving relationships, what could transform if you applied those same principles consistently over a long period?
Interesting question. Applies everywhere, potentially.
It really might. So if you found this analysis helpful, and if you're curious about how these simple, well-researched ideas can lead to big results in investing in other areas, make sure you're subscribed for more insightful talks like this one. We're always here digging into the research to help you get well-informed, quickly, and thoroughly on topics that really matter.